Hi, everyone. This is the One Point Podcast, and I'm Rohit Yadav. We recently released a comprehensive ecosystem wide report called as Rethinking Venture Capital, a Strategic Lens, in which we explored the entire value chain of the venture asset class. Now, within this overarching strategic report, time and again, I explored themes which are complementary with people who have tons of experience as venture experts. So I'm absolutely thrilled to have Michael Sidler, co-founding partner at Redalpine, with me today. Michael, thanks for joining in.
Rohit, thank you. It's a pleasure.
So Michael and I have been connected over social media for some time, but as many connections go, I haven't had the chance to speak with him till now. So I'm glad that he is joining today and talking to us on all things European venture and Redalpine as a VC firm. Brief background: Michael has a PhD in molecular biology. After an initial management consulting stint in 2003, he joined Pyronics, one of the early Swiss role model startups. And what is super interesting is that he has been an angel investor since the dot-com bubble. So that's quite some time. And I think that itch of investing led him to start one of the most enduring VC firms in Europe, which is Redalpine in 2006. So Michael, what is Redalpine?
Yes, you're quite right. I mean, we have been around since roughly 20 years now. Redalpine is a rather conventional venture capital fund, one of the first funds in Europe. We have been covering Europe from day one quite broadly. And meanwhile, we have grown into a multi-stage VC with a platform of funds. We're a sector agnostic investor, so we always want to invest at the forefront of where the disruptive changes are happening, and we have the ambition to always invest in those technologies. So we are a fairly broad setup right now, investing out of fund number 7, but raising fund number 8 in the early stage, and we're also raising a growth fund.
Okay. So tell us about the background of starting Redalpine, because it's almost 2 decades, right? So there must be some ups and downs, some highlights from your portfolio if you want to cover.
I mean, obviously, we started with Alpine because we had the passion for innovation and for starting companies and for entrepreneurs. And we saw there is a huge amount of innovation getting created in Europe, but it's not getting properly commercialized. And so we said there has to be a better way to basically fund companies without always this syndication process as angels. There has to be a professional way to do that, and therefore we set up a seed stage venture fund in round 6. We didn't know, obviously, what we're getting ourselves into, and we just did it because we felt it's right. And obviously, we also faced really a number of huge challenges on the way. I mean, when you kind of think back, we started in 2006, raised our fund in 2007, started to invest during 2007, and went right into the great financial crisis that hit us pretty badly. Nobody knew really at that point in time what would happen. And we basically said, let's take the money and run. We kept executing quite stubbornly our strategy. And later that paid out because the investments we have been doing, they started to flourish. But at that point in time, it was really, really difficult and a lot of uncertainty. That was one of the big challenges. And obviously, we started a company. It was like a startup, a founding team with all the ups and downs. So it's really also a founder's journey that you go through, and therefore the well-known roller coaster.
Okay. And you have spent so much of time, so there must be some portfolio highlights. And I know one of your portfolio companies was in the news yesterday, if I'm not wrong. So tell us all about the portfolio from those 7 funds.
Yes. As I said initially, we have predominantly started out in the seed stage, early in seed stage. So we have done a lot of seed investments. But by now, we also have our evergreen fund structure that does stage agnostic investments. So therefore, we also have some later stage investments that we have done directly and indirectly. A number of companies that have become very successful and large from our earlier funds is one of them is, for example, 26. We have invested in the seed round there. We have invested in a company called Taxfix. Many people know Taxfix. We have invested in a company called Inkit, which is disrupting the media business a lot and which is growing like crazy, especially also in the US. We have invested in a company called Quera. It's a more recent investment, but it's an investment in a company that really participates in the AI boom. They provide security solutions for AI models. We have invested in a company called Proxima Fusion. It also illustrates very nicely the breadth of our investment scope, like from fintech to media to AI to fusion technology in the energy space. And we have also invested in a company called Araris. It's a biotech platform company that we just sold in April this year for $1.14 billion to a Japanese acquirer.
So, Michael, you have invested in so many big names. You have been investing for almost 20 years through Redalpine. If you have to chalk out top one or two investment, let's say, thesis or ideology for yourself, not for Redalpine, but for yourself, what would those be?
To be honest, it's changing. It's
Okay.
not like you can set it and then that is it. But having said that, the most important factor by far, especially if you invest early, this is the quality of the team. And the quality of the team is really difficult to determine if you cannot go into a data room and read the CV and then figure out if it's a good team or not. You have to see them in action. And so what we really like is to see talented founders very early on, and then to have points of interaction with them such that we can follow their trajectory and then extrapolate that into the future. I believe thesis-wise, banking on talented founders is really almost the most promising thing. The rest is always extremely difficult because, yes, a technology could be incredibly intriguing at the point in time when you invest. But don't forget, the exit will happen in 5 years, maybe in 4 years, maybe in 7 years. And the world may be completely different by then.
Mm-hmm.
And the best bet you have to come to a good outcome is usually the nimbleness and adaptability and execution strength of the team, of the founders.
Okay. So your core focus, according to you, is team, team, and team, right?
Yes, there is one additional element, and you alluded to it in the beginning of the introduction. It's quite right that myself and also my co-founder, Peter Niederhauser, we have experienced the dot-com bubble. We have experienced it as angel investors, and Peter, especially also as an entrepreneur himself. And what you can learn in this kind of an extraordinary situation is that in these such dynamic market conditions, the giants of the next 20 years get born and forged, but thousands of companies fail. And we then basically took a step back and asked ourselves, why does a company fail, or what's the distinction between a company that fails and one that succeeds? And one pattern emerged besides the quality of the team, and that was something we call the tech hedge.
Okay.
I would say it's a non-trivial, innovative substance. It could be a patent, it could be an algorithm, it could be a prototype. It's just an innovation or an invention which is giving them a core, and which is, out of experience, we can say, making companies much more resilient in the situation of a crisis. So we really look for companies with this so-called tech hedge. That's a super important element.
Yeah, super important. It's kind of a secret sauce, right?
To a certain extent.
Yes, got it. So let's move on to the core of this discussion. And I was inspired by some of your recent posts on social media. And one of those posts was about the European tech ecosystem. And you call the current moment as the best VC market setup that you have seen in a long time. And when you said that, I mean, it's 2 decades, right? So what makes you so optimistic about the European tech ecosystem right now, despite all that macro noise which is happening right now?
Yes, I mean, thank you for picking this up, and I think it's important to give some comments there. First of all, yes, obviously we are acting in Europe and we're investing in Europe and we're big fans of Europe, and I'm also very convinced of the strength we have in Europe. But the comments are more fairly general about the overall ecosystem globally. Nevertheless, that applies pretty much also to Europe, and then some elements are specific to Europe. So first of all, what you can say, the markets go through ups and downs, as we all know. The stock markets have recovered from the change in interest rates in 2022, really big time. They're on all-time highs. The private markets have not so much recovered. They have started to recover, but a gap has opened since 2022. The valuations overall of public equity is much higher than the valuation of private equity. That means there is a gap that is going to close, and we see that happening now. That's the first reason. The second reason is the IPO window, which is super important, obviously, for GPs, VCs, but also for the LPs, is opening. We have seen since the last couple of months a number of tech IPOs that went really well. By the way, we're also anticipating the IPO of Klarna tomorrow at the New York Stock Exchange. So it's a European company that goes IPO. This is just psychologically changing things tremendously. Then interest rates are heading down, meaning money is getting more available, money is getting more affordable, meaning that money is going to flow back into private equity, it's going to flow into public equity. But since the public stocks are already on all-time highs, you can imagine that people start to diversify also into the private markets. Then what you also can say is that historically you can observe that in tougher environments, you usually have the best VC vintages. And we have gone through a rough patch. And you could imagine that now we start to see really good vintages happening. And some investors are anticipating that as well. So therefore, we see that at Redalpine. Then two more reasons. It's a technological reason. I, again, alluded to the dot-com bubble. We're in this kind of a development again. I wouldn't say it's a huge bubble, but it's a dynamic, turbulent change brought about by, and that's changing everything. Even if it's a bubble, even if we have higher valuations and they're going to correct, the changes that are happening, they're not going to go away. So this is just turbocharging many companies, startup companies, but also more, advanced companies. Last, very Europe-centric reason why I'm quite optimistic for the current VC environment and basically also for the startup environment is that Europe has learned that it has to start to become more independent, meaning we have not to depend also technologically on other powers. So that means we have to support and fuel our own innovations, build our own hyperscalers, become independent when it comes to space and technology and so on. And that just the logical consequence of this is, and we see that already big time, that a lot of stimulus packages are getting tight and that a lot of money is starting to flow into the support of innovation technologies and also startups.
Okay. I want to double down on the last and the second last point that you mentioned. So the last point was very European centric, and the second last you mentioned about the AI and how even if it's a bubble, then it will still have repercussions throughout the tech and the larger ecosystem. So Europe traditionally has lagged behind the US, if I may say so, in producing the tech giants. When I say tech, I mean startups who then scale up and then become tech giants, right? So do you think this AI race or this AI era could be a bit different where there's an inflection point for Europe and Europe can be on the equivalent scale as the US in producing competitive giants?
Fantastic question, and not an easy answer. I'm not entirely sure if the race is on and Europe is far behind. And Europe is also not helping itself by easing up the regulation and creating a market environment which would be beneficial for these kind of companies. I mean, I see tendencies that people want to change that, and obviously that's going to take some time. The reason why I'm still optimistic for Europe is Europe has a traditional strength in what I would call, in a broad sense, deep tech. So it's not when you not just need software, when you need software in combination with other technology. I mean, there is a very interesting, let's say, talk with the former science director of NASA, Thomas Zurbuchen, originally a Swiss. He has been many, many years the science director of NASA. He retired, he came back to Switzerland. And the reason why he comes back to Europe is because he sees that the vocational education you have in Europe is in combination with the technological development is really, really very interesting and a great asset. To make it less theoretical and more concrete, people in Europe are better craftsmen. They can, for example, weld, they can just build stuff. And when you want to go to space and build a rocket, you need just talented welders, for example. There is another really interesting anecdotal story. The company Proxima Fusion from our portfolio, the fusion company in Munich, they're building a fusion technology based on the Stellarator. The Stellarator technology is a very advanced concept. I'm not going to go into details here. There has been a team in Princeton also trying to build an experimental plant and one in Germany at the Max Planck Institute. In order to build this kind of a plant, you need extremely precise magnets. Princeton gave up. They could not build the precision magnets that were required to operate this kind of a power plant. The only Stellarator plant in the world is in Greifswald. It's called Wendelstein 6, and it could be built with German precision. And so therefore that's really an advantage we have in Europe. And if we combine that wisely together with AI, we definitely could have a competitive edge there.
Got it. So the question was really regarding the AI, but when we talk about AI, it's not just AI. What you see is a combination of deep tech in which Europe has traditionally done really well in terms of talent, in terms of education, as you outlined. So this combination is what you think can really put us Europeans forward in comparison to the US, competitiveness and so on. Got it.
We have an opportunity there. I mean, you can still miss it. As I say, if you're playing football, you're alone in front of the goalkeeper with the ball. The goalkeeper even slips. You still have to hammer the ball in. We have an opportunity there, but we still can miss out. It's not a guaranteed success by far.
Okay. So I want to switch the conversation to the capital side of it. You already mentioned the talent. It's understandable. There has been reports, education, understandable. Again, in the reports, proven. What about the capital? There are billions now being unlocked via different methodologies, let's say, in public funding to flow to the European innovation. Yeah, due to this geopolitical tensions that you mentioned already. How do you see this ecosystem of capital let's say, in competitiveness with the US? Do you think, first of all, to make it simple, do you think there's enough capital for the venture ecosystem in Europe? If not, do you think it's been unlocked enough, whether from private, let's say, capital, or it could be public funded capital?
Okay, there are a number of convoluted questions and I'm trying to dissect them. So is there enough capital or not in Europe? Yes and no. It really depends to a great deal on the stage. Europe over the last 10 years has developed a fairly professional, also well-functioning early stage ecosystem. It's still a little bit underfunded, but it's not dramatic anymore. So if you start a company, you can find your seed round, and on the also let's say a normal Series A, you can find the money in Europe. If you grow as a company, grow up, and you raise larger rounds from 30 to 50 to 100, even to 500 million, usually in most of the cases, you don't find the money in Europe. It's still fantastic that European companies can attract money from overseas in their growth stages. It's a testament to their quality, but it's sad that we cannot finance them with European money because the returns obviously also then will end up overseas. So growth stage is underfunded in Europe big time. And that's exactly why, by the way, we started to raise our growth fund, because we have a fantastic quality of startups. They're looking for money, they're underfunded, and therefore it's a buyer's market.
Okay.
That's one thing. We have, I mean, governmental money and support and all of that. To a certain extent, it's required, but you know, it's like when you, I mean, by the way, I'm a biologist by training, as you probably mentioned. If you fertilize your plants too much, you kill them. And that's the same with money, governmental money. Some fertilizer is required such that the plant can grow. But if you give too much, you kill it.
And what about the private ecosystem, the private capital? I mean, that's the bigger discussion, right? The pension systems of Europe not putting in enough capital towards the venture ecosystem and so on. To what extent do you think that the private institutions are not seeing this opportunity of venture and venture creating jobs and venture creating new innovation, venture creating new technologies, venture pushing Europe forward? So do you think it's more cultural, risk off mindset? Do you think the returns are not attractive enough? I mean, what's stopping the private capital to flow into the growth side of business?
All right. It's really the core of almost everything. Yes, the backbone of the American boom in venture capital and also startups has been traditionally the institutional investors. And yes, they're very much absent in Europe. They're just not deploying money. It's almost overall, it's really, really minute, the amount that are getting deployed into venture capital in Europe. There has been a study from Redstone. I think it's absolutely crazy to see in Germany that, I'm paraphrasing here, the German institutionals own about 0.2% of German startups, and American institutionals, pension funds, they have about 10% in those startups. It's just showing, it should be the other way around. It's just showing the gap there. Why is this the way it is? There are a number of reasons, in my opinion. First of all, it starts probably very early on. The risk takers, to a certain extent, have left Europe to, you know, for example, to emigrate to the US. So by definition, some of the people here have just a more conservative risk off attitude. Secondly, and that is really a pity, and going back, you know, my historic view, in Europe, the venture capital industry started to emerge together with the dot-com bubble. So in the late 90s, you saw the first emerging European venture capital investors. They collected money, from pension funds. They invested the money into the dot-com bubble, and then the bubble burst. And many of them lost a lot of money. Has stigmatized this entire asset class to a certain extent, and we are still suffering from that because many people say we're not going to do that again. That is one of the reasons. Then there are more reasons. Overall, it's just this historical and cultural elements that culminate.
What I feel is there are a lot of again, not to say anything negative, too negative out here, but there are institutional investors, there are people who are actually not ready to take on the risk. I mean, maybe the compensation structure is not in the right model for them. So the amount of risk of being negative for them is too high. If something goes wrong that comes in under their name that they didn't invest in the right way versus the positive outcome of venture. So maybe that's also one of the reasons here.
Taking risk is not rewarded, and you're not incentivized to do that. And therefore, as somebody in a pension fund, sometimes you take the really absurd decision to invest in government bonds with negative interest rates instead of investing that into the private markets, probably just out of career reasons.
Okay. I want to talk about Redalpine Banking 26, and you mentioned a couple of other companies. What patterns do you see in the European founders? What does it take to win within the European ecosystem from your perspective?
Obviously that's a personal opinion, but I don't think that founders in Europe are different from founders in the US and from founders elsewhere. On the contrary, it's quite interesting if you meet people from all over the globe and their founders. They're very similar to a certain extent. They have similar passions, similar drives, and that's also the case in Europe. I think something which is different is that the most ambitious founders in Europe, they don't take it for granted that you go to market in the country where you have set up your company. So I think it's the duty of a founder to move your company or to go to market where you find the most fertile ground,
Okay.
and not necessarily where you happen to start your company. So meaning if you start a company in Germany and then you figure out that probably the market for your product for your product or for your service is much bigger in the US, then by all means go and do it in the US and don't try to build it up against all odds and against the regulation in Germany or in Europe. So I think that's one of the biggest differences, but generally people are quite similar in their driven nature.
Understood. So agility in terms of scaling up the business model, wherever you see fit, go there. That's kind of the one succeeding factors for the ecosystem. Okay. I want to move to another very critical and important and actually intriguing social media post from you, which was focused on the US tariffs on Swiss products or Switzerland in general. I know this is a moving topic. This is a very touchy topic. So I'll be careful in asking this question, framing this. How does the mindset translate into an investment approach? Meaning, there are tariffs on the Swiss products. Does it stop venture in doing its business? Yes or no?
Yeah, I don't think at all. For obviously, if you're investing as a more like a private equity investor into a very traditional Swiss product, let's say chocolate, and all of a sudden your exports to the US are taxed by 39% on top, then that really is an issue for your business. If you build a startup company now, you can adjust for that. It's really not that difficult. It also doesn't apply to all products. Software is not included. If you have products that you need to manufacture somewhere, then by all means, don't do it in Switzerland. And then obviously you can evade quite elegantly those tariffs. So I'm not certain if it's, I mean, obviously it's a blow for the Swiss economy, but there will be ways around that, quite certainly. The thing which makes me more let's say, negative for which is kind of a point which I believe is not going to go away so quickly. This is just the fact that you cannot rely on rational rules anymore. And that it's not like we have a rule and we apply it and we commit to it. It's more like I do it because I'm stronger and because I can do it. And that is really a signal which is a devastating signal in a liberal world. That's the biggest problem, in my opinion.
Okay. So from your perspective, I think the startup founders as such, just by the sheer of development cycles of their own product, of their own markets, I think is somewhat insulated. And it's more of an issue for more established ecosystem within the Switzerland for Swiss products and so on. And even then, there are ways out of it, as you mentioned.
Sure. Yes. Yes. I mean, Switzerland is anyhow very, very special in that respect because you have a very small home market. So you almost never produce in your products for exclusively for your home market and then export parts of it. And then secondly, usually the labor costs are very high. So by definition, when you start to establish a company that produces products, you start to produce them anyhow somewhere abroad. Then so therefore, if you're building up a company now, the tariff problem is not such big a problem for yourself. It may be a problem for other players. Yeah.
Okay, got it. So if you zoom out from the tariff is kind of a component of geopolitics, right? You mentioned geopolitics a couple of times. So if you have to look Europe overall, and if you have to look at your portfolio, maybe outside your portfolio, do you see some concrete examples on how your deal flow has changed and how you have started to invest maybe differently in last 1 to 2 years?
Yes, we did. Some things are pretty obvious. There are suddenly a lot of people starting to invest in defense tech. It's a bit cynical, but a couple of years ago, the big hype was sustainability and ESG, and now the big topic is defense tech, and not certain how long that will stay a big topic. Having said that, yes, it's quite obvious. Europe has to invest a lot of money into its defense. That's for sure. And technology will play a big role in that. So therefore, if you ask me, do you see changes? Yes, we do. Companies that would not have labeled themselves to be a defense company, now they openly say it. That's a change. It's still the same technology as before. For example, we have exited a company that has developed software for autonomous airplanes and drones. And
Mhm.
obviously, it was always a software for pilots and for autonomous planes. Now, all of a sudden, it falls into the defense bucket. It's the same company. It's just labeled differently. So this is something we see. I guess the very immediate changes that are happening right now, they haven't trickled down too much to deal flow yet, but we will, I think, see changes over the course of the next couple of months.
Okay. And when you select a deal or when you decide to invest into a deal, does topics like geopolitics, rise of the defense tech, and all these themes play a role into your ideology, or do you think them as hype cycles and you evaluate every single deal on its own merits, so to say?
Yeah, the latter. Exactly as I said in the beginning. Since we started with Redalpine, we had the ambition and still have the ambition always to be able to invest at the forefront of the, let's say, bleeding edge of what is happening. And so you can imagine these topics, they change. When we started out, the hottest thing was the smartphone and social media. Now you have defense tech, you have energy, you have fusion technology, uh, you have even quantum computing. A couple of years ago, you had food tech, you had blockchain, you have many names. Eventually, we're always trying just to evaluate the innovation, the technology, and its potential, and the founders, and not to fall too much into one of these word buckets or categories.
Understood. Since the time is low, I want to move to the third bucket, which is also super interesting. And because you guys are involved into this topic deeply, which is democratization of venture, right? So you have a fund which is called as Summit Fund. Please correct me if I'm wrong, which is focused on this semi-liquid evergreen model. Tell us about it and how it's different from the traditional closed-end 220 model of VC funds.
Yes. So the reason why we started in 2006 Redalpine was we observed an opportunity in the market. There is innovation, there are entrepreneurs, but not enough money. And we said, if we have professional money, it's an opportunity and it's a need. So that's why we then started Redalpine Capital One. Now, a couple of years back, since then, we have always been talking to investors. Obviously, that's what you do as a VC. You need to raise funds too, not only the startups. And we started to understand there is a gap in the market because there are investors who would like to deploy money into the private markets, into venture capital, but they're not comfortable with a product that is a closed-end fund, that has capital calls, that is completely illiquid, and that is a blind pool, and also that cannot be kept in a bank account. We said, okay, is there a way to cater to this market to basically take advantage of this opportunity, because there are investors who would like to invest through a different structure into this market? And we ended up then creating the Summit Fund, which is an evergreen structure. The beauty of it is it's semi-liquid. It can be kept in a bank account. You don't have any capital calls. You have compounding returns. From day one, you invest, you're 100% invested. You have no capital calls. And it's also not a blind pool. You can check today what's the portfolio of the Summit Fund, and then you can decide if you want to invest or not. This is a product for many investors, high net worth individuals, or just people in the private banking space and also in the wealth management space, but also, by the way, for smaller institutional investors. For them, it's really a product that fits their needs much better. Obviously, it has also downsides, this product. It's not easy to manage the liquidity, and the liquidity management is also basically going against the returns. So you have a lot of advantages, but also you would have to expect a slightly lower return with this product when you compare it to a traditional closed-end venture fund. There is one philosophical thing which is really interesting. LPs complain about not having enough DPI redemptions. The decision, or just the DPI itself, is being generated by the GP of the fund when he or she sells a position. Then you have redemptions that go back to the LPs. In the situation of the Summit Fund, after a lockup period of 3 years, you as an LP can decide, I want to redeem. And then the decision to generate DPI is in the hand of the LP and not in the hand of the GP anymore. And that's a huge difference.
Understood. So when you said semi-liquid, you mentioned this 3-year kind of lock-in period, and that makes it semi-liquid, right?
Yes, and also, I mean, it's not like, you can just, I wake up in the morning and I say, oh, I want to liquidate. That doesn't work. You have a long notice period of 12 months for now. We're going to reduce that, but right now you have a notice period of 12 months such that the fund can generate the liquidity it needs to cater to the redeemers, for example. So therefore, you can liquidate it, but it has certain
Understood. So Michael, how big is the Summit Fund right now?
The Summit Fund has a volume of roughly 150 million right
Okay.
now, but it also has quarterly closings. So every quarter it's growing somewhat.
Okay. Understood. I think you touched very nicely upon this topic of the different requirements of individuals as well as the wealth management, asset management firms, which might not be focused on investing a lot of capital into venture, but smaller amounts, and they're looking for a different kind of product. Do you see from your conversations, obviously with the banks and asset managers, that the need for this product is growing much more? Or do you see in the next, let's say, 2 or 3 years, the demand being stagnant?
Now the demand is growing a lot. This is one of the additional, let's say, elements that is contributing to why I am very optimistic about the future of venture capital in Europe. It's the asset class is coming of age. So people start to be really interested in it. It's really interesting if you look at it on a longer term perspective. When we started with Redalpine, when you were a founder of a company, people regarded you with pity. You did not get a good job at Siemens or at McKinsey or at Goldman Sachs or wherever. No. Now this poor guy has to start a company and he risks his health and his family life and his pension fund. So you were not a rock star. Fast forward, you have the Höhle der Löwen, you have Dragon's Den, you have all kinds of competitions. You're a rock star as a startup founder. That means many of the brightest, best and the brightest from the universities start startups, and people start to understand that it's an interesting asset class. So that's a paradigm shift which is happening also on the with the investors. And so therefore, going back to your question, yes, we see a lot of interest in this asset class and we see it growing a lot.
Okay. And do you think this democratization will eventually change the way startups are funded? I know we discussed about the public capital coming into venture. We discussed about the institutional capital. Do you think this democratization might overtake this private capital gap, which is there in venture? Or do you still think we are too far away from democratization?
It will not. Maybe there will be something like ETFs or something that could give people access to this as a class. But it's some of the elements of this asset class you would regard to be a bug, but actually it's a feature.
Explain.
It's good that the stock of startup companies is not publicly tradable because there is not a large enough market for this. So therefore, these companies need to have peace and quiet to follow their business model to build up their company, and they cannot be requirements to basically cater to a publicly traded stock. So being illiquid and being private is a feature. It's not a bug. It's intentional. And yes, it's much more risky. And that's why you need to have much larger portfolios of investments. So either you have a very broad portfolio as an investor, and therefore you have to have a lot of money because you need to balance the risks. Or if you don't have that, then you have to be just very, let's say, open to just have a lot of losses in your portfolio. And if you invest your money into a couple of public stocks, I mean, the risk is much lower. You still can lose money quite clearly, but it's a different risk return profile. And therefore, coming back to my initial statement, the democratization of the asset class is a double-edged sword. It's not so easy, and some of the elements there are deliberately chosen and are better for the asset class.
Okay. Last question on democratization from my side. In terms of placing, you said the role of a GP is also to raise capital, right? So you're raising capital from LPs, whether that LP is an institutional LP investing in your, let's say, Fund 7 or Fund 8, or whether it's this democratization that leads you to talk to the banks and so on. Is there a difference when you discuss about venture capital, about your fund, when you discuss with institutional investors versus the banks?
It's a huge difference depending on who you are. I mean, depending on the different LP type. Very big. Some people are excited by technology. They're really passionate about it. Some people couldn't care less. They just want to see the risk return profile. You need totally different arguments. And as I said, it's quite interesting as well. As a GP, you build products for your customers. Your customers are LPs, And you have to build products which fit with the needs of those LPs. And if we have a product that is not matching the needs of an LP, you can pitch as long as you want. You will not get anybody investing. So therefore, you really have to cater or shape the product to the needs of your target group, and also tell the story accordingly. I think this is super important. Just like with the startups need to be able to convince the investors, and basically it's exactly the same situation.
Last question from my side. What's next for Redalpine?
Yeah, I mean, obviously Redalpine is growing with the European ecosystem, to a certain extent, also shaping or co-shaping with other early funds the European ecosystem. We definitely will expand. As I mentioned earlier, we have this kind of a platform with early stage funds, growth stage fund, evergreen structure. Wherever we observe a demand in the market, we will try to create the product based on that platform. That's definitely for the medium future of Redalpine.
Understood. Thank you so much, Michael, for joining in and having a chat discussion. It's so nice to meet you face to face for first time and having this chat and covering actually a lot of ground. So we talked about the European tech ecosystem, about your post on what makes it the best environment, one of the best environments to build this VC firm and to raise capital as startups. We talked about geopolitics. We covered a lot of things on tariffs and so on. And then finally, obviously, democratization, where Redalpine firm is active as a semi-liquid product, evergreen product. So thanks a lot for covering such a big ground, Michael. Thanks for joining in.
Thank you so much, Rohit. It was great fun. See you soon.